I know it doesn't look great from the title, but I'm here to shed some light on the current situation, the current narrative, and how we can all come out of this smiling. What is happening, everyone? Welcome back to my channel. Hope you're all well. The S&P 500 is down over $10 trillion from the high. That's right, $10 trillion from the all-time high to where we're trading right now. It's not great, right? It's not great. We're currently 25% down from the high. Officially, obviously, in a bear market, it takes 20% from the high for any asset class to be considered bearish, for it to be considered in a bear market. Why is this? We obviously know the current narrative. Every single central bank is fighting. Everyone's raising interest rates. Everyone's going for the fences for demand destruction, simply to cool down economies, to reduce people's spending, and pretty much shrink everything that we've inflated ourselves over the past few years. The reason things have inflated the way they have is because of all the money that was printed over the pandemic. Every economy provided stimulus in some sort of form. Was that through bond purchases? Was that through fiscal stimulus in the form of checks to people to spend, to prop businesses back up? All of that comes at a cost. We know that, unfortunately. We're obviously facing the wrath of that now. The question is, how long until they pivot? I know this week was a very interesting one that shocked the markets, it rattled the markets. You had the Bank of England pivoting from what was expected to be an interest rate hike in an emergency to obviously assist the pound. They diverted, they pivoted. So now there's a lot of fear and a lot of uncertainty as to say, okay, is the Federal Reserve going to follow suit? Are the ECB going to follow suit? When do they pause? I know the current narrative does stem from higher interest rates for quite some time. However, the question now is, how long for? So we're going to jump on the charts. We're going to run through that. What to look out for, where the S&P can go next, how we can capitalize on that, what's going to get us out of this situation, and when we should start buying the dips, be that on an ETF tracker, be that physically buying some shares and some assets that I'm going to run through. And yeah, we can go from there. Stay tuned. Right, so the S&P 500 right now, down over 25% from the high. Yes, $10 trillion. That is a lot of money. Pretty much just wiped off the face of the earth. Now, looking at the S&P, I have covered this in my original Big Short video. The question now remains, looking at the monthly time frame, this is an extremely, extremely bearish closure. I know back in 2008, looking at the monthly time frame, there was adequate positions and there were adequate times and opportunities to enter this as a short position to bet against the S&P, pretty much bet against America. Now, my only concern is, you know, these lows have just been breached. We've just hit fresh 2-year lows. The last time price was trading around this price was back in November 2020. Obviously, after the COVID lockdowns, once stimulus started ramping up, that's when we hit that high. I personally, however, I want to look at a rough medium. Why I say that is I want to look at where price was before the pandemic and where we could possibly be after we had that flash crash. So in my opinion, a good little target for the S&P is 2750. Now, why I say that is, and I've obviously just put an alert there with you guys right now, 2750 was an average, a mean average where the market traded in and around before COVID, right? And roughly after the flash crash. So the flash crash that we had over there in March, that was obviously down to COVID, full global lockdown, right? Everyone coming to a standstill. We had that immediate V-shaped recovery. And if you don't know what a V-shaped recovery is, it is simply when you have that crash and you have an immediate recovery thereafter. So V-shape, straight from the lows. So for myself, I do favor a rough average from where we used to trade at before the flash crash, before the recovery. So if I have to take half of that, right, use your fib if you want to get a half. But I do like anywhere between 2,800 or 2,750 for this to be the sort of bottom for the S&P. Why am I still so confident that, let me get this tool out. Why am I still so confident that we're going to fall another 20%? The Federal Reserve are not over. The Bank of England's pivot does not mean this is over. This simply means they've taken a breather. The Bank of England in particular took a breather to help pension funds, to assist the mortgage market. That does not mean the current inflation narrative is over. Obviously, you got people here, or the new chancellor here in the UK, cutting taxes, which is a form of stimulus, which is going to still cause high inflation. It's not going to solve the problem. So my only concern is I feel we're in for a regime change. We've had low interest rates for years, right? That has propped up the markets. We've had all these businesses since 2008 running up loans, right? Running up credit. Look at the national debt limit, the debt counter in America. Almost 40 trillion. I'll try and put something over here. 40 trillion that it's approaching. So my concern is everyone's racked up all this debt because interest rates were cheap. Interest rates were low. Everyone took out a mortgage. No one can afford that now. We've already seen the mortgage rates in America hitting above 7%, the highest since 2007. What happened in 2008? People could simply no longer afford the mortgages that they were promised. Hence, what happened? Hence, the crash. Everything came crashing down. You had all these banks that were buying that debt, right? All those banks that were financing those mortgages all came crashing down because no one was paying their mortgage. The same thing is going to occur, in my opinion. You have, in the UK, 26 to 27% of mortgages in the UK are variable rate. That means if a situation like this where central banks have to raise rates, you're in an ugly position. I personally know of people that can no longer afford their mortgage due to what's happened. That is the severity of what is actually going on. So when I say a regime change, I do feel if there is a regime change of higher interest rates and for us to stay high, a lot of businesses are going to struggle. A lot of the current tech companies that rely on debt, rely on low interest rates to survive, aren't going to be able to operate. And that is going to reflect in earnings. That is going to reflect in letting go of staff. That is going to affect the global stock market, the global sort of equity market and risk appetite in general. Looking at that from a technical charting perspective, I do expect 2,800 to get sort of retested. Why do I favor that level? I mean, if you have to zoom out, I'm not betting against America long term. I do understand that this correction will be survived. We will survive this correction. It is just a matter of how many people we shake out. So for myself, I think this could be one of the greatest fibs of all time. Fibbing from that COVID low, to that 2020 high that we had over there, 2021 high, that we had over there. That does line up with my fib, right? Anywhere between 3,000 and 2,800 on the S&P. I favor starting to dollar cost average my way in to equities. Should we see that, that's another 20% to the downside, then I do favor starting to buy this dip. This is something that we see all the time. Big finance companies, everyone gets used to the current environment and the current conditions that they're in. People over leverage, people get greedy. We know what happens, right? It's vicious cycles that continue all the time. When people over leverage, people get greedy, something has to reset. Something has to happen. Someone has to pay for that. They're more than likely going to blame the working class, right? They're going to blame the working class for spending too much money. What's going to happen? They're more than likely going to come and introduce some form of stimulus should this happen. Mortgages are going to fail. People are going to lose their homes. It's not looking great. My question to you is, are you ready? Have you created an environment where you can succeed regardless of what the governments are telling you about what's going on? Create that environment. It doesn't have to be trading. Start your own business. Figure something out that if the market presents itself with a generational wealth opportunity to buy the dips in assets that were too high, were overpriced, use your time wisely. We still have a good 6 to 12 months before things really get serious. So use your time wisely. That's pretty much it for me. And the S&P, it is down 25% of the highs. To summarize, I do expect the target for the S&P around 2,800 to 3,000. And that's where I'm going to be buying the dips. Guys and girls, I appreciate you watching this video. Stay tuned on the channel. I'm going to be bringing a lot more content. Follow me on Twitter. I'll put my Twitter handle over here. I'll see you all in the next video. Take care. Bye-bye.